Hello, my name is Mike Sinibaldi and welcome to this week's video edition of Heard on the Street. This edition is the last video where I'm only going to focus on the Emini SPs. I appreciate everyone's patience while I'm updating all my long-term charts in anticipation of next weekend's release of my mid-year forecast. This week I'd like to take a look at the 2007-2011 analogy from a monthly perspective. As you can see, I'm still working the triple combination, and there are several key pieces of information that this larger time frame provides. Number one, the long-term trend line that has provided support for the market throughout the 2009 advance has been broken to the downside. Likewise, this also occurred from the 2002 advance to the 2007 high. The MACD predictor is a dynamic indicator developed by Joe DiNapoli. It's clearly on a sell signal and shows significant selling pressure as it did in 2007. Notice that the selling intensified as the MACD predictor moved away from where the signal was generated, and as it did here in 2011. This confirms that sellers have entered into the market in a big way. The analogy calls for another up, down, up sequence, up, down, up, and subsequent tests seen here at the weekly chart level of the 40-week simple moving average, or otherwise known as the 200-day simple moving average, before free falling. If a similar test of the 40-week simple moving average were to occur, my expectation would be for the test of that moving average to occur below the neckline, possibly somewhere in this area. Number 4. The 2007 and 2009 declines show harmonic 0.382 retracement levels, which are normal and customary. Number 5. At the weekly chart level, I've previously shown that the declines are also similar, i.e. 265 points from 1527 to 1262, and 255 points from 1352 to 1097. One thing's certain, this is not a coincidence. Either this is the biggest con I've ever seen being played by large market participants, or one of the greatest history lessons the market will ever tell. With worldwide central bankers and politicians meddling in the markets, we've always got to be on guard and protect ourselves from being blindsided by their manipulative ways. Case in point was the Fed's announcement of QE2. Will ban short selling in Europe stop the bleeding, or will QE3 be unleashed here in the States, causing another risk on trade? We don't know, but by using the wave principle, we know where we're wrong. Key resistance is at 1252.25. Prints above this level indicate that my analysis may be flawed. Finally, dropping to the daily chart level reveals supporting evidence that the analysis remains intact. I've labeled two expansion series. The first series measures 1367 to 1252. Notice that the 2 times multiple has already been hit and exceeded, with the 2.618 multiple just below the market at 1066. The second series measures 1352 to 1292. Notice here that the 4.236 multiple was met. In my experience, when prices reach either a 2.618 multiple or greater, there's a high probability that the entire move will not be fully retraced by the next move. This aligns well with the up-down sequence that I mentioned in the beginning of this video. I hope you found this video helpful and best of trading.